to today's meetup. Build today, scale tomorrow, your capital strategy blueprint, part two. We're so excited to have you here. We think this is such an important topic for subcontractors, and I'm really excited to be joined by some really great guest presenters as well. My name is Mark Reyes. I'm part of the marketing team here at Build. And today we're going to be building on our previous meetup to talk about some of the core elements of a strong capital strategy, explain why that's important, and give you some actionable takeaways that you can implement in your business today. As a quick recap, in part one of our series, we talked about the importance of having a diverse set of capital options at your disposal and how subs should be thoughtful in how they use each option. I think it was Luke Boyinger who told us, keep in mind, it's the right tool for the right job. We also discussed how you can build the right finance team and how those roles might change as you grow your subcontracting business. And then we finished off by talking about how subs can optimize their financial processes to support sustainable growth and build a really resilient business. And today we're going to build on those topics, and we're going to be focusing on explaining what the cash flow deficit or funding gap is, why it's important, and what you can do to kind of mitigate the risks associated with it. We're going to discuss profits and profitability. Profitability is something that all subs are focused on, but what do you do with the profits when you bring them in? That's really important. And then we're going to finish off by talking about supplier relationships and how you can negotiate to get the best unit cost. And I'm really, really pleased to be joined by three construction industry veterans. We have Travis Mayer from Build, Johnny Johnson from Kurzumi CFO and Advisory, who works with Luke Boyinger, as well as Raul Pacheco, who is the owner of RDP Electric. So I'm going to let those guys go ahead and introduce themselves.
Yeah, appreciate it, Mark. Travis Mayer, been with Build going on 4.5 years now, from the industry for about 10 years, give or take, before that. And I oversee our partnership with Turner Construction today in my day-to-day. And but I've got to have thousands of conversations with trade partners and subcontractors, over the years, and really excited to be talking about some of the topics today.
Yeah, thank you, Mark. I'm Johnny Johnson. I've been in the CFO capacity for probably the last 25 years with a heavy focus on construction and engineering type of clients and firms. Heavy background in doing restructuring and workouts and sometimes turnarounds for companies that actually get into a problem with, bad working capital strategies. But happy to be here today.
Hey, Mark. Yeah, thank you for the invite. I'm super excited to be here. And as well with you, gentlemen, thanks for having RDP be part of this. So we're going on about 11 years that I started RDP. And we started from a kind of small residential contractor to now handling about 6 states in the Southeast. We handle mid-rise to high-rise apartment projects, and yeah, super excited to be here.
Excellent. Well, thank you all for joining me. We're really excited to have you here. So let's go ahead and just dive right into our first topic. And I want to start with you, Travis. At Build, we talk a lot about the funding gap. Can you briefly explain what that is and why it's such a common and persistent challenge for subs?
Yeah, I mean, it's I talk to folks all the time who started their business in one form or fashion many years ago, or some just last year, and the conversation always ends up heading in the direction of not only did you start a construction company, you really started a collections company, and that is a basis. And I see Raul shaking his head already. That's an misunderstood reality of how money moves in commercial construction. The funding gap, as it pertains to subcontractors, refers to the shortfall between available financial resources and the total cost required to complete a project or series of projects. Cost overruns, underestimating project costs, change order amounts, processes, not quite refined, being underbilled during a project. These can all contribute to, and in addition to other things, but these can all contribute to the funding gap. But what we really see is the biggest causes of contractors becoming collection companies over the years is delayed and inconsistent payments that contribute to ongoing cash flow timing challenges. If you have constrained operating profit margins, ongoing weekly expenses, and long inconsistent payment timelines, the business will be subject to the ebbs and flows of individual project cash flows, and then on the aggregate throughout the year, right? If you're a seasonal contractor. So there's a saying, in addition to contractors being collection outfits, we go as our cash flows. And I think that really rings true in our industry.
Yeah, absolutely. I thought that was a great overview. And now I want to put up a poll and see what everybody in the audience thinks. So the poll question is, when a funding gap occurs or when you've experienced this before, what is the biggest impact on your business? And I will say we don't have the option to choose multiple of these. So maybe just, and you may have experienced all of these at once, but which one do you think has had the biggest impact on your business? And the options we have listed in the poll are delayed payments to suppliers, difficulty making payroll, needing to use personal or high interest funds, delayed project timelines, or it hasn't really impacted us. And one thing I forgot to mention, just giving you a little bit of overview of what you're seeing. You've got your chat on the right. You can chat amongst each other. Let us know where you're calling in from. You also will see a poll section. So that's where you'll go right now. I've just put up the poll. Go ahead and answer there, and we will review during the Q&A section. And then right below polls on your experience, you're going to see a button for Q&A. If you have any questions throughout the event, go ahead and pop them in the Q&A. You can put them in the chat, but the best way to ensure that you're getting your questions answered are to put them in the Q&A section. So let's go ahead, and I want to keep on with this topic. And, Travis, I thought you gave some really great examples. And Raul, I'd love to hear from your personal experience at RDP. How have you dealt with this funding gap, and how is your approach to managing the funding gap and the challenges associated with change as your business has grown?
Yeah, so I dealt with that funding gap, firsthand when we transitioned from that residential to the commercial market. We quickly learned about retention, long pay times, and just supplier terms. And we attempted to use traditional financing options like lines of credit, MCA loans, which we all know are nightmares, and traditional factoring companies. But none of those were as efficient as Build. And so really Build has closed that gap for us and helped us streamline and fund all of our projects so that we can focus on growth.
Yeah, I think that's great. Have you seen your approach to, not just dealing with the funding gap, but really just managing your capital stack? How have you seen that grow as you've grown your business?
Oh, it's been great. We've been able to really just separate kind of funds that are going to be used for growth and funds to fund our projects. So it's really helped us kind of keep everything tight.
Yeah, absolutely. Johnny, from a CFO's perspective, how do you think that having a strong capital strategy in place is going to help a sub bridge the funding gap between what they owe and what they have available?
Well, it would actually allow them to have dedicated working capital rather than quote just profits. Having dedicated working capital, a strong line of credit to pull from, it helps smooth out those timing differences between your accounts receivable collections and your vendor payments and things of that nature, things that you don't want to get behind on. So that's one of the things we look for as a CFO is, do they have a dedicated working capital, or are they just relying on their profits?
Yeah, and to dig in on that a little bit more, what do you see as the biggest benefits to having multiple capital sources at your disposal? We talked in our last meetup about the importance of diversity in your capital stack. How do you think that relates to being able to manage this funding gap?
I think it helps to having, multiple options available to you because it builds your credit, if you will, or your rapport with lenders. It gives you multiple options where if you're confined to one specific lender because of the shape of your financials, you could be paying higher cost of borrowing money. And we try to steer, our clients away from that to give them an opportunity to have multiple borrowing sources and staying current with them and to eventually work themselves into a situation where they can get to a bank and a line of credit that's reasonable for their business.
Yeah, that's a great point. And, as we mentioned during our last meetup, there's a strategy behind how you deploy those options as well. I think we see oftentimes talking with subcontractors, their instinct is just to go with the cheapest option available. And a lot of times that's cash, but there's an opportunity cost to using your cash to cover operational expenses, right? You're missing out on potential growth and investment opportunities that you could otherwise be using if you were to instead leverage things like build, other construction specific financing, your bank line of credit, supplier terms, everything like that.
Hmm.
And then Raul, I did want to go back on your response about how you manage the funding gap. Besides having a financial partner like Build, are there any other processes that you've built in and put in place that have an impact on the funding gap for you?
Yeah, so definitely having good terms with suppliers has kind of helped close the gap with the payment terms that we have with our clients. So for us, it's between 30 to 90 days while we get paid, and we've been able to create strong relationships with suppliers where they're able to kind of align those terms so that they help us kind of do like a pay when paid um, kind of strategy. And so that's the other really strategy that we use other than build.
Yeah, absolutely. And that's a great preview for what we're going to be talking about later in the session when it comes to supplier relationships and strengthening those to benefit your business.
Yep.
So I think this has been a great overview of the funding gap, what the challenges are, how can you help solve them. And I want to move on to our next topic, which is profits and profitability. And what do you do with your profits? Like I mentioned earlier, profitability is a huge focus for every subcontractor. You're ideally working jobs that are going to be the most profitable. But I think what sometimes can get missed or just lost in the day to day is what do we do when we bring those profits in? And how are they potentially strengthening and helping our business? So I'm going to put up another poll. And this one is, how do you use your profits today? And we have a couple of answers on there. There may be other ones, but so for how to use your profits today, the options are A, we keep it in the business and use it as working capital, something that we commonly see. B, we keep it in the business as retained earnings. C, we distribute profits to ourselves as the owner or stakeholders. And D, we don't really have a plan or strategy around what to do with profits today. So again, that poll has been put up. Go ahead and submit your answers, and we will review that during the Q&A section. So Travis, on this topic, I want to start with you. And in our latest industry report, we discovered that 40% of subcontractors are keeping anywhere from half to all of the profits they make in the business and using it as working capital. Why do you think this is such a common practice in construction, and what sort of impact does it have on a sub's ability to grow their business?
Yeah, I mean, we're really getting to some of the root cause issues of cash flow challenges in the industry, right? And I'm going to throw some numbers out here, Johnny. Keep me honest. Uh, you know, I would typically see average operating profit margins, for some of your critical pathway subs or your main trades, utilities, earthwork, MEP, roofing, exteriors. That operating profit would range 6 to 9% with other niche specialties in the 10 to 15. And if you're a more well-established business with a lot of processes in place, you could definitely be in that 12 to 15. But when you think about it, you have retainage being 5 to 10%, depending on the type of work that you do. You're essentially pushing out most, if not all, of your operating profit until the end of the project when you can collect retainage. And there's a reason that traditional lines of credit with traditional banking partners exclude AR past 60 or 90 days, right? There's a reason that retainage is not something you can borrow against or really cash flow forecast when it's going to be available, right? And so if you are operating on thinner profit margins and then you have retainage included, every new project you take on because of the funding gap, you are deferring profitability, right? And then if you have uh, thinner margins, just in general, uh, there's times during the ebbs and flows of individual project cash flow curves where your expense outlays are higher than maybe another given week, right? And so the all this to say is the margin of error is razor thin on both sides. And so when you think about, can I take out more than my ownership salary? Can I take distributions, or if I'm a ESOP, like what does that process look like if I want to either build up retained earnings or actually take money out of the business so that I can achieve, legacy value from what the business is creating? Those processes can be done, but they're few and far between. Majority of the time, we would see those profits kept in the business and reinvested in working capital because you're taking on more projects and deferring those profits and deferring those profits. So, retainage and inconsistent payment timelines that don't match your vendors and sub tiers create the cash flow constraints. Even when the business is performing well by historical standards, I would typically only see enough working capital to cover 3 to 6 weeks of operating expenses, right? And so back to zero margin of error, you would never apply that math equation to your personal finances, right? But it is an everyday reality for trade contractors in the U.S. of, I got a lot of money in the account this week, and next week it could look very different, and then the following week a different payment comes in, right? And so this is a reality a majority of trades experience month to month. And large mid-market trade contractors are not that different from smaller contractors in this regard, especially if they're growing. So they may have more zeros in all of the financial columns, but they'll experience a similar margin of error as a smaller contractor, if not more, because of the project size and the exposure and the risk associated with it, right? If you're getting into 50, $60 million contracts on individual projects and you're carrying 200 to 300 employees, you do have some more resources available to you, but when something goes wrong, it can definitely go wrong very quickly in projects of that size. And so in summary, extracting profits or distributions from the business above and beyond what's needed to operate and invest in growth is possible, but it requires very tight processes, a culture of high performance, and an aligned leadership team across all aspects of the business to execute on it.
Absolutely. I think, we talked about this on our last meetup as well, but the idea, it's such an important point. The idea of, having limited working capital, if you've only got 3 to 6 weeks worth of project costs in the bank at any given time, it makes sense that subs might see it as risky to be taking that profit out of the business, even if it's to distribute it to themselves. But that's why you built this business in the first place, right? You wanted to be able to reap the rewards of your labor, but without having a strong capital strategy in place, that could seem as a risky endeavor if you feel somewhat limited in the capital available and the cash in the bank.
And
So,
I would say, Mark, an exit strategy goes with that.
right.
Your proactive capital strategy now and how you operate today should be influenced by the goal you have for the business in a long-term exit strategy. If it's a legacy business you want to pass to your kids, if it's private equity, if it's you want to get bought by a larger contractor in your space, or you just want to sell the business in general to someone else who wants to run it, or ESOP, employee stock option plan. All of those have slightly different approaches to how you create enterprise value in the business to make sure that return later is achieved.
100%. And Johnny, I want to get your perspective on this topic. As a fractional CFO, if you're working with a sub that is consistently using their profits as working capital, How does that concern you?
Well, it's a good question. I mean, it definitely can cause a cash flow constraint or strain, and many times it turns into a cash flow crisis. You don't leave any room for emergencies. You talked about it earlier, Mark, with opportunity cost, having the opportunity to invest in the future of your business. Travis mentioned it as well, with the legacy business. When you're trying to decide what you want to do long term, but I've had several clients that are living day to day based on those profits, and had one client recently that use those profits for their own personal sort of checkbook, to pay for everything. They just thought that that was part of why they started that business, and they had the right to do that. And it has caused them some extreme cash flow issues. So that's something that we try to sort of steer them in a direction of why there's a difference in working capital versus the profits, and why you can't just continually use the profits to fund these projects, and you need another alternative.
Yeah, it's certainly a huge challenge, and I think, like you laid out, there can be extreme circumstances that really put the pressure on the business. But the good news is that there is hope. There are solutions. So, Johnny, I want to stick with you. In your mind, what can subs do to kind of change their mindset about how they use profits and think a little bit more strategically?
Well, again, I think, separating profit from working capital, that's sort of sometimes a big challenge because some clients don't quite understand what that actually means. Using your profits to build retained earnings, Travis mentioned that for some enterprise value. That does improve your balance sheet, and then that leads over to when lenders are looking at your balance sheet, your financials. How strong is that, and how much do you have in the business? What is your borrowing base and your opportunity? And the lenders many times will see less risk with that and can increase your borrowing power, and in some cases your bonding capacity, et cetera, so that you can actually get bigger projects and grow your business.
Absolutely. Raul, I'm really interested to hear from your perspective, um, after hearing from Travis and Johnny and thinking about like how common an issue this is. How do you at RDP manage your profits, and how does it help fuel growth and fuel growth on the one hand, and also ensure that you're benefiting from your hard work as well?
Yeah, so I want to kind of touch on what Johnny said about the bonding, because we're actually going through that. We are kind of chasing some pretty big projects now, and the first thing we needed to do was increase our bonding capacity. And what that includes is having an audited financial, and our balance sheet needed to be very strong, right? And it's something that we had to learn this year, and so it's something that we had to improve and kind of make it strong so that our bonding capacity can also be strong to take on these newer projects. So yeah, I'm sorry to kind of backtrack on that, Mark, but I just really wanted to touch on that because we're dealing with that right now.
Yeah, of course. And I think it is a really great example. Is there any example you can think of when using profit strategically has made a positive impact for your business?
Yes, yes. So uh, prior to COVID and the supplier kind of disruptions, we decided to to kind of make a strategy of a profit first approach to things, and create like a 6 month to like a 12-month cushion. We didn't specifically know at that time what it would be used for, but we wanted to have that cushion. And so when COVID came, um, lead time started to hit pretty badly, and we used a lot of that cushion to pre-purchase material and essentially help a lot of our clients avoid liquidated damages. Um, and so that ultimately created a strong relationship, and made us the preferred vendor to a lot of these GCs now. And the reason for that was the subs they were using didn't have the buying power that we did at that time. They kind of just planned it job by job, day by day. and they didn't have that capital to pre-purchase material or negotiate strong terms with vendors. And so we were able to kind of use that to our advantage. And to this day, it's really helped us out.
Yeah, that's a really long-term impact, right? To be able to impress your GCs like that and become a preferred sub, that is going to pay dividends for years down the road. Um, Before we move on to our final topic of the day, Johnny, I did want to ask you about timing. Given that we're approaching the end of the year, what do you think is the importance of timing in terms of having a strong balance sheet, tax planning, and planning for and setting growth goals for the next year as we get towards the end of 2025?
Yeah, it's a fair question. When I was running, and I've had the responsibility of running up to $1 billion industry as the CFO responsible for that. We'd start our budget process in early September for the next year. Going through the budget process takes time. You want to do it. You want to do it right. A lot of clients that we have now, though, the subs, they have to wait till year end, and they may have a tax advisor or an outside bookkeeping firm that then gives them all this information to quote true up their books at year end. And so timing is very important. We try to coach our clients not to wait to the end of the year. We'd like our clients to be sort of, month to month, have a good close plan. But yeah, now that we are here in, October the 22nd, timing is very important. You want to try to start getting your balance sheet cleaned up, get ready for the year end close. I think it's vital that, you kind of have account reconciliations that tie out, and that most importantly, that your budget you're preparing for is achievable. And you've looked at everything from your gross margin, your operating expenses, et cetera. And a lot of companies, subcontractors, they put that off to the year end. They don't think that that's the most important thing. That they just think in their minds, well, we're doing pretty good. We're winning more jobs, and we'll be better next year. And they really need to take maybe a different approach to that.
That's really great advice, and it kind of fits in with our theme of being proactive in your capital strategy. Focusing on the day to day is really important, but being able to take a long term outlook, not just with your working capital, but with everything that involved in running your business, planning and setting your growth goals. So I think that's something that subs could be implementing today.
Yeah. And Mark, to chime in on that, and Johnny, your comment, to put it succinctly, if you are someone who's focused on a tax deferral strategy or just minimizing your taxes versus Raul, the example you just said, you guys were in the process of increasing your bonding capacity. What you're doing at the end of the year and how you're approaching your balance sheet for just those two options alone is vastly different. And so waiting to the end of the year to decide that that's how you manage your business or based on the long-term goals of the company is too late, right? And so to your point, Mark, it all comes back together proactively, but it's not one single bullet you can fire. All of these things come together in throughout the course of the year.
Yep, 100%. So let's go on to our final topic of the day, which is supplier relationships and negotiating better unit costs. So, Travis, I want to go back to the industry report, our latest industry report, where we learned that subs on average wait 56 days to get paid. A lot of times it's more than 56 days. It could be 80, 90, maybe even more than that. On the flip side, most subs, something like 80% of the subs, only have net 30 terms, right? There's clearly a mismatch here. But what I want to know from your perspective is, how does this affect the unit cost that subs are paying for materials?
Yeah, it's a great question, and there's a bit of background here as well that you kind of have to zoom out for a second to get back into the details. But the consolidation of the supply chain over the last 10 years and then changing macroeconomic conditions, have resulted in lower credit limits, stricter adherence to stated supplier terms with their clients, so on and so forth. And what I mean by all that, you would have, I won't use their name, but they're a very large mechanical manufacturer, and they enforce 60-day terms no matter what. If you're their largest account, they cut you off at day 61. If you're their smallest account, they cut you off at day 61, right? And you have some of these larger companies purchasing some of the more regional suppliers that, folks have had handshake deals with for many years. And when you have the consolidation of the supply chain and then interest rates rising, risk in the market, or perceived risk in the market anyway, some of those ways or methods that worked previously are not working anymore. And so if you built your business around the ability to have 60-day or 90-day payment terms and those shrink to 30, that is a rapid adjustment to cash flow in the business that you weren't able to plan for, especially if you've built kind of processes around that. And so this shift from pay when paid agreements to more enforced terms can exacerbate the cash flow challenges, as I said. In the event that longer terms or pay when pay are still viable with your suppliers, and this goes back to what you mentioned earlier, Raul, then you can be sure that the cost of those terms are accounted for in the price of materials, and maybe that's okay because you're probably accounting for it too, Raul, and it's not causing you to lose any jobs potentially, but you're not going to have a multi-billion-dollar manufacturer or supplier have their dollar floating on the street for free, just like we wouldn't expect subcontractors to bankroll projects for free also. And so the cost of those terms is accounted for in the pricing. So can you negotiate, having a capital stack that allows you to strategically negotiate with your suppliers and vendors puts you in a position to be creative and proactive, which it sounds like, Raul, you guys have already started that process. Can I negotiate higher mobilization from my GC or owner? Does the GC have an early pay program I can take advantage of? Does this 1% net 10 that's printed on my invoice apply to this large material order I have coming up? Or does payment within 10 days mean more to the supplier given the high dollar amount associated or the time of year, right? So suppliers are not impacted by cash flow or how money moves in construction in the same way that subs are. And so, if I consolidate my vendor list, and so some of the things you can do, if I consolidate my vendor list down from 8 to 4, I guarantee them a certain amount of work quarterly. What does my monthly or quarterly pricing sheet look like from a unit cost perspective, right? So there's all different levers that is a proactive conversation to be had with your partners, right? The same way, Raul, you mentioned partnering with GCs. Suppliers, downstream vendors, second tier subs should all be brought in on managing this process together, as opposed to everybody passing the buck, so to speak, because everybody will win in that regard. And you'll have the opportunity to negotiate, either higher credit limits, better terms, lower unit costs, bulk ordering, you name it. If you get everybody to the table, there's a positive win-win-win situation that can be found.
Thanks. That was really great context, Travis. Johnny, I want to get a CFO's perspective. What do you think are some of the financial practices and processes that a sub can implement to strengthen their negotiating position?
Well, definitely, and it's been touched on already, I think, with Raul and even some of the things Travis said. Having a really strong balance sheet. Hopefully, these companies have a CFO that's educating them, if you will. I like to run the ratios on the balance sheet. I like to encourage my clients to go to multiple banks, ask the same questions. They end up getting told the same thing. They get told in a different way by different people. What are you looking for if I come to you for a line of credit? So they're not just hearing it from me. they're hearing it from multiple sources of how important it is to have a strong balance sheet, to have those favorable ratios, if you will, consistent payment terms to suppliers and vendors that, Travis sort of mentioned, having the reserves built up that Raul mentioned earlier. And you guys took all the thunder out of my answer with, maybe taking advantage of some early pay discounts and some opportunities, to save some money. Get out in front of, going back just a little bit, Mark, when you talked about year end and budgeting, in addition to starting our budget process early, we also started our vendor negotiation early, before the end of the year, so that our vendors understood, what we needed, what they needed, et cetera, and vice versa. And one fun thing I learned early in my career, as a CFO, was, managing accounts receivable and accounts payable is like having two kids that want to argue and fight. And so the best thing to do is just bring them into the same room. And when my AP people came to me and said, "Hey, they're complaining they haven't got their money yet," and I said, "Well, let's get the AR people in here and let's see what they have to say." And so we bring the accounts receivable team in, and they say, "Yeah, I'm calling asking for money, but they're frustrated with me calling asking for money." So I put them both in the same room, and they end up coming to the same conclusion that they're both very important, but managing the lifeblood of your accounts receivable is a daily task that needs to be done. That's the concept of the whole revenue cycle management. It's not just, hey, we delivered and we sent an invoice. It actually has to get collected, and put in the bank. Travis mentioned earlier, there are companies that are doing it. They treat everybody the same, big or small. And a lot of times our clients will say, "Well, you don't understand. If we call and ask for money, they're not happy." Well, what's happening to you when your vendors are calling asking you for money and you're not happy? So, those are some of the things we try to do, teach and coach with our clients, but stressing the importance of a strong balance sheet, running the ratios, explaining to them what that means, and then how those two, accounts receivable and accounts payable, sort of work together. You got the statistics up on the screen. Average sub waits 56 days to get paid, and they got 30-day terms with their suppliers. That's upside down. And you can't, if you had to pay all your bills personally before you got your paycheck, none of us would be able to make that.
Yeah, you really hit the nail on the head, especially when we talk. We just get back to it again and again. Being proactive versus reactive. You're likely to never regret having these conversations early, but you may regret having these conversations late, especially when something like unit costs could have a direct impact on your bottom line.
And Johnny, to expand on that, right? I love the kids analogy, by the way. But there's cousins involved and there's uncles involved, right? And so if you've got a cousin on the legal team who reviews your contracts, and you've got a cousin on the estimating and bidding team, right? And then you've got overall executive leadership of the company based on the long-term vision. Finance, ARAP, and the CFO, manage what goes, gets funneled to them, right? But there is a lot of things that can be done on the front end. And so when you put the whole family in the room together, that's when the positive business processes and impacts can really hit the accelerator.
Absolutely.
Raul, I want to jump to you and see if you have any examples of how having a strong capital strategy in place and being proactive in negotiating with suppliers has given you any leverage in those negotiations.
Yeah, absolutely. So we have a pretty unique process of go with our suppliers. And Travis, I think you mentioned, going from 8 different vendors to 4 could really help a company. That's kind of what we did. So we do have a lot of vendors that supply materials, but we like to really create a strong relationship with 4, 5, or 6, just depending on the project size. And so what we do when we want to create a new relationship with a vendor is there's always a conversation with their credit department, right? They want to know who we are, and it typically involves financials. So we show them balance sheet, we show them kind of the pipeline, and that gets their confidence right away. Seeing a strong balance sheet, seeing good payment terms or repayment terms, it really gives them a good sense of security to working with RDP. And so we go from there to getting a dedicated account manager, which we create really strong relationships, and they provide great insight and market trends that really help us negotiate the pricing with other vendors, and they give us insight. Sometimes it'll come down to they'll tell us, copper it's pretty high, got hit with a bunch of tariffs, but just wait a couple months, and we do that, and it has saved us hundreds of thousands of dollars, and essentially increased our bottom line.
Man, that's a really, really big impact. And we keep going again and again back to having a strong balance sheet. And yeah, it's easier said than done, but I think we've talked about a lot of really concrete ways that subs can strengthen their balance sheet today. And I do want to make sure we leave enough time to do Q&A, but as we wrap things up, I'd love to hear from each of you. What's your one key takeaway that you think that subs should take away from today's session? Let's start with Travis and then Johnny and Raul.
Yeah, I mean, I think I just hit on it. And we mentioned the word proactive a bunch. What does that mean? That means getting every team that interacts with each other in the room to sort this out, right? So Johnny's example of AR and AP, that's one piece of it. But I can't tell you how many companies we've worked with where I'll have a call with somebody, or we'll have a cash flow forecasting meeting or what have you, and they'll be like, I agree with everything you're saying. Can you come help me talk to the rest of our leadership team on approaching it this way, right? And so the proactive piece is having the tough conversations and getting executive leadership alignment within the company on what it is where it is we're going, because we can all work on our individual pieces to help get us there. And that includes operations, that includes estimating and pre-construction, that includes financial processes, that includes how the field communicates with the office. There's so many things that go into that include your contract negotiations and legal, that you can't solve it. You can solve pieces of it with certain teams, but you're not going to solve all of it and really hit the growth accelerator within your business if not everybody's on the same page, and everybody's doing small parts or processes related to how money moves within the business.
Yeah, and I think for myself, Mark, wrapping this up, there's been a lot of terminology used today. So one thing I'd leave the listeners with is, find somebody, whether it's build your current CFO or a CFO, that can help you understand these concepts. We've heard, capital stack, working capital, capital structure, bonding capacity, cash flow, DSO, ratios. I can tell you, my granddad built every home and building on his 40 acres of property in North Carolina, and was a phenomenal farmer and a phenomenal builder. He couldn't tell you what any of these things meant, but he always had money in his pocket, and all of his buildings and his homes were fantastic to look at. But he just didn't understand these types of terminologies and why they're important. So when we're saying to the group here today, strong balance sheet, try to understand, what does that mean? What does the capital stack mean? What does your cash flow, actual cash flow, what does that mean in your business? And those are the things I'd leave the listeners with today, is to understand these terms and terminology, because that's what's going to get them to when they can get a better line of credit with a bank to actually grow their business, and then they can talk the talk and walk the walk, so to speak.
Yeah, and I think, in my experience, a lot of subs just focus on cash flow and don't have a capital strategy. They see money in the bank, and they think they're fine. And no, I mean, it's been my experience where you need a strong finance team strong accounting team, and like Johnny said, that can really educate you on what all this terminology means. I mean, they definitely educated me. I'm not a financial expert like you guys are, but my team has definitely educated me on what each one of these terms mean and how they're going to impact my company. And it's been great. So definitely agree with Johnny on that.
Wow, what an amazing session. Thank you guys so much. So many, great points being made, little nuggets of wisdom. So we were so happy to have all of you here. And I think now we are ready to go ahead and jump into the Q&A.